Imagine waking up one morning to find that everything you trusted about the economy was a lie. Your bank is still standing, but behind the scenes, a silent chain reaction has already begun, one that has triggered every major depression since 1873, from the Panic of 1907 to the Great Depression, from the 1970s crash to 2008. Most people never notice this moment because it doesn't look like a collapse. It looks like growth, right before the fall. This pattern, this six-stage path that disaster keeps repeating even today. It's almost as if the global economy is following a script buried in history, a script no one wants you to read. To understand the pattern, we have to go back more than 150 years. To the year 1873, it was called the Great Panic. Railroads were expanding faster than profits. Newspapers claimed a new economic age had begun. Sound familiar already? But underneath the excitement, something dangerous was forming. Stage 1. The illusion of endless growth. This is where the pattern always starts. The government and businesses promise a future of easy money. Investors stop asking questions. People trust the system simply because it has worked before. But history shows that the more confident the public becomes, the more fragile the economy actually gets. By 1873, the entire financial structure looked strong on the surface, but its foundations were cracking. And just like that, the next stage began. Imagine pouring water into a glass. Then, without warning, it spills everywhere. That is exactly how credit works before a crisis. In the late 1800s, banks began creating money out of thin air through loans. Railroads borrowed more than they could repay. Investors used leverage to buy stocks they couldn't afford. Ordinary families took on debt believing the future would pay for it. This same stage appeared again before 1907, before 1929, when margin debt exploded, before 2008, when mortgage loans grew like wildfire. But back then, people didn't see it. They thought debt meant progress. They thought borrowing meant opportunity. Every depression in history begins with the same mistake. People confuse easy credit with real wealth. And this mistake pushes the system to the next stage, one that is always hidden, always quiet, and always ignored. By 1873, something terrifying was happening behind closed doors. Banks were making bets they couldn't cover. Railroads were running out of cash. Investors were buying assets with money that did not actually exist. This leads to stage 3, the invisible stress point. This is the moment when the system becomes too fragile to handle even the smallest shock. No alarms go off. No news headlines scream danger. But beneath the surface, a single failure alone that can't be repaid. A company that collapses, a rumor that spreads can trigger a chain reaction. This exact hidden breaking point reappeared. In 1907, when one failed trust company froze the entire financial system. In 1929, when a few margin call failures led to mass liquidation. In 2008, when subprime mortgages cracked and brought down global banks. The pattern is so consistent, it's almost eerie. Every depression starts quietly, no drama. On September 18, 1873, the investment firm J. Cook & Company suddenly collapsed. To the average person, it didn't look like a big deal. Just one name in the newspaper. But in reality, this was the spark that hit a mountain of dry powder. Stage 4. Sudden collapse. Railroads filed for bankruptcy. The stock market fell so fast that people didn't even have time to react. It's the same thing happened in 1907 when bank runs spread like fire. 1929 when Black Tuesday wiped out fortunes overnight. 2008 when Lehman Brothers collapse froze world markets. The fall is never the end of the pattern. After the crash of 1873, the United States entered a 6-year depression. Unemployment exploded. This is stage 5. Public suffering and systemic damage. Governments always act surprised, as if they couldn't see it coming. But the truth is, the warning signs had been growing for years. The same fallout struck after. 1907, manufacturing collapsed. 1929, global trade fell 65%. 2008, millions of homes were foreclosed every time. Leaders promised that the crisis was unexpected, even though the pattern was almost identical. But the most dangerous stage, the final stage, was still ahead. When the 1873 depression hit, the government tried every quick fix possible. They pumped money into railroads, and for a moment it looked like things were improving. But these solutions created something far more dangerous. Stage 6. The reset that sets up the next collapse. Every depression ends with actions that cause the next one. The fixes hide the cracks instead of repairing them. They push the debt further instead of reducing it. They create temporary relief that slowly turns into the next bubble. This is why the pattern repeated in 1907, 1929, 1973, 2002, 2008. The end of one crisis is always the beginning of the next. Section 1 has shown how the six-stage crash pattern was formed. A pattern built on illusions, credit, hidden stress, sudden collapse, painful fallout, and failed fixes. But the most shocking part is this. In Section 2, we will walk through the modern signs, the signals in today's banking system. The debt levels no one is talking about, and the hidden cracks that look almost exactly like the ones from 1873, 1929, and 2008. The pattern is repeating right now. And just like in 1873, 1907, 1929, and 2008, it begins with a familiar illusion. Look around. The stock market hits new highs. Real estate prices soar. Tech companies grow faster than ever. Governments promise that inflation is under control, that growth is strong, that the new economy is different. But every generation says the same thing right before a collapse. Because stage 1, the illusion of endless growth has already returned. People believe central banks can print money forever. They believe interest rates can stay low without consequences. They believe the global financial system is too advanced to fail. But history has proven, again and again, is the moment the system is most fragile. Debt is rising faster than any time in human history. Governments borrow to cover deficits. Families borrow just to survive rising prices. This is stage 2, the credit surge, but on a scale bigger than 1873, 1929, or 2008. In the last 20 years alone, household debt in many countries is at record highs. Corporate debt is at levels that would have been unthinkable in earlier eras. U.S. government debt crossed new milestones so fast that economists stopped trying to predict the ceiling. Just like the railroad mania of the 1870s, the trust company bubble of 1907, the Wall Street leverage of 1929, and the subprime mortgage boom of 2008, people today believe debt equals progress. This is the stage few recognize because it doesn't make headlines. Look closely at the modern economy, and the same silent warnings appear. Banks relying on short-term funding, tech companies burning cash with no profit, households using credit cards to cover basic expenses. And the most dangerous warning sign? This is exactly what happened before every major depression in history. The world is now paying more interest on its debt than ever before. This means any shikini failure, any rumor, any sudden loss of confidence can trigger stage 4. And just like 1873, the spark may come from a place no one expects. Every major crash begins with something small. 907. One trust company fails. 1929. One wave of selling triggers panic. 2008. One bank, Lehman Brothers, goes under. Today the spark could come from anywhere. Government missing a bond payment. A housing market suddenly freezing. What makes stage 4? Sudden collapse so terrifying is that no one recognizes the spark until it's too late. One day everything feels normal. Banks freeze credit, and the world realizes the hidden breaking point was much closer than anyone admitted. When the fall begins, the speed is shocking. Jobs disappear, small businesses close. This is stage 5, public suffering and systemic damage, and every sign suggests the next fallout could be larger than 2008. Because today's economy is more interconnected, more leveraged, and more dependent on constant inflation than any economy before it. In earlier crashes, only banks failed. Today, an entire nation's digital economy can freeze with a single glitch. And just like in every previous depression, leaders will pretend they couldn't have seen it coming. But the pattern has been visible for more than 150 years. History repeats because the response is always the same. When the next crisis hits, governments and central banks will offer the same fixes. Print more money. Add new regulations that sound strong but fix nothing, promise recovery within months. These are stage 6, the reset that sets up the next collapse. In 1873, the bailouts fueled the next bubble. In 1907, new credit deepened the 1929 crash. In 1929, easy money set up the inflation of the 1970s. In 2008, massive stimulus created the asset bubble we see today. Every fix becomes the fuel for the next crisis, which raises the question: what will the next collapse create? The illusion, the credit boom, the hidden stress, the sudden collapse, the fallout, and the failed fixes. The pattern is unmistakable. It happened in 1907, and it happened in 2008, and the same illusion, it's the same debt, the same dangerous belief that this time is different. But history whispers the same warning. Every major depression followed the same six-stage pattern, and today, all six stages are forming again. Crashes never come from chaos. They come from small sparks hitting an overloaded system. Every fix that leaders use ends up building the next crisis, creating a repeating cycle that lasts for centuries. If this pattern has repeated every time for 150 years, what makes us believe we can escape it now? If you want to understand the hidden forces, the forgotten warnings, and the financial system shaping your future, subscribe to Economy Rewind. We uncover the past because it keeps repeating.